Have you ever wondered how finance became one of the most important fields in the modern world? Today, finance influences every aspect of our lives, from businesses and governments to our personal savings and investments. But finance didn't become this advanced overnight. It evolved gradually over centuries through economic changes, technological innovations, and intellectual discoveries. In this video, we'll explore the evolution of finance by understanding the 9 major stages that shaped modern finance. Let's get started. 1. Emergence as a distinct entity. The first stage in the evolution of finance was its emergence as a distinct field of study. For centuries, finance was merely a subfield of economics or a basic branch of accounting. It didn't exist as an independent discipline. Financing a business simply meant keeping track of cash receipts and paying bills. It wasn't until the late 19th and early 20th centuries that finance emerged as a distinct entity, shifting its focus toward the legalities of corporate mergers, expansions, and how firms structured their internal funds. Initially, finance was considered a part of economics and accounting. It mainly focused on raising money for businesses and governments. As business organizations expanded, finance developed into an independent discipline with its own principles, objectives, and methods. This marked the beginning of finance as a separate academic and professional field. 2. Industrial Revolution and Technological Advancement. The Industrial Revolution brought significant changes to businesses and economies. Factories, machines, and large-scale production increased the demand for capital. Businesses needed more funds to purchase machinery, expand production, and hire workers. At the same time, technological advancements improved transportation, communication, and banking, making financial activities more efficient and organized. The Industrial Revolution changed the scale of human ambition. Mass production, steam power, and national railway networks required unprecedented amounts of money. Individual business owners or small partnerships could no longer fund these massive operations alone. This era forced the financial sector to mature rapidly, creating massive investment banks and robust stock markets to pool public money together. This period greatly increased the importance of finance. 3. Application of analytical methods. As businesses became more complex, financial managers could no longer rely only on experience. They began using analytical methods to make better financial decisions. Techniques such as financial ratio analysis, budgeting, forecasting, cost analysis, and investment evaluation helped businesses reduce risk and improve profitability. As corporations grew into sprawling empires, relying on gut feeling or basic bookkeeping to make decisions became too risky. Finance began adopting rigorous analytical methods. Financial managers started looking closely at liquidity management, working capital, and analyzing financial statements to evaluate a company's health before committing capital. Finance gradually became more scientific and data-driven. 4. The Great Depression and Recovery. The Great Depression of 1929 was one of the most severe economic crises in history. The 1929 stock market crash and the subsequent Great Depression completely reshaped the financial landscape. Thousands of businesses failed, banks collapsed, and millions of people lost their jobs. This crisis revealed the importance of proper financial planning, government regulation, and risk management. The focus shifted overnight from aggressive growth to survival, preservation of liquidity, and bankruptcy reorganization. During the recovery period, countries introduced stronger banking systems, financial regulations, and better investment practices to prevent similar crises in the future. This era gave birth to intense government regulation, such as the creation of the SEC in the United States, to restore public trust. Finance became heavily focused on safety, disclosure, and structural stability during the recovery phase. This event permanently changed the field of finance. 5. Emphasis on external financing. Following the recovery, the mid-20th century saw a massive boom in corporate expansion. Companies could no longer rely solely on their internal profits to grow. As companies expanded, they required more capital than owners could provide alone. Businesses increasingly relied on external sources of finance, such as bank loans, bonds and debentures, shares issued to investors, financial institutions. Choosing the right combination of internal and external financing became an important responsibility of financial managers. The discipline of finance shifted its emphasis heavily toward external financing, how to optimally raise money from outside sources through the strategic issuance of stocks, corporate bonds, and commercial bank loans. 6. Emergence of modern finance. By the 1950s, finance underwent a total philosophical shift. It transformed from a descriptive, legalistic discipline, explaining what things were, into a normative, analytical discipline, explaining how to maximize value. Finance shifted its focus from simply raising funds to making better financial decisions. Concepts such as wealth maximization, risk and return, capital budgeting, portfolio management, dividend policy became central to financial management. Rather than just managing cash, financial managers became strategic decision-makers focused on maximizing shareholder wealth. The objective was no longer just earning profits but maximizing the value of the business. 7. Use of computer technology. The introduction of computers transformed finance completely. The late 20th century introduced computers to Wall Street, changing the speed of money forever. Algorithms replaced manual calculations, and massive databases allowed for real-time tracking of global markets. Financial institutions began using computers to process transactions, maintain records, analyze data, and prepare reports much faster than before. Computer technology enabled the creation of complex financial instruments, high-frequency trading, and automated risk management systems that would have been physically impossible to calculate on paper. Today, software performs tasks that once required hours or even days. Computer technology has made finance more accurate, efficient, and reliable. 8. Intellectual advancement in finance. Finance continued to grow through research and innovation. During this technological boom, finance cemented itself as a rigorous academic science. This era was defined by groundbreaking economic theories that earned their creators Nobel Prizes. Economists, researchers, and financial experts developed important theories and models that improved financial decision-making. Concepts such as portfolio theory, capital asset pricing model, or CAPM, efficient market hypothesis, option pricing models, Modigliani-Miller theorem, capital structure, modern portfolio theory, diversification, and the Black-Scholes model, options pricing, helped investors and businesses better understand investment risk and expected returns and turned finance into a highly sophisticated mathematical discipline. 9. Modern finance. Today, we live in the era of hyper-globalized, digitized modern finance. It is an ecosystem driven by quantitative analysts, quants, artificial intelligence, and global networks. The modern landscape balances traditional corporate finance with asset management, venture capital, complex derivatives, and tech-driven platforms like fintech and decentralized protocols, all operating 24/7 across borders. Technology has completely changed how financial services operate. Modern finance includes internet banking, mobile banking, digital payments, online investing, financial technology, or fintech, artificial intelligence, blockchain technology, cryptocurrencies, big data analytics. Financial transactions are now faster, more secure, and accessible from almost anywhere in the world. Modern finance continues to evolve as new technologies and innovations emerge. Conclusion. Let's quickly review the 9 stages of the evolution of finance. 1. Emergence as a distinct entity. 2. Industrial revolution and technological advancement. 3. Application of analytical methods. 4. The Great Depression and recovery. 5. Emphasis on external financing. 6. Emergence of modern finance. 7. Use of computer technology. 8. Intellectual advancement in finance. 9. Modern finance. These stages show how finance has evolved from a simple function of managing money into a sophisticated field that supports businesses, governments, and individuals across the globe. Understanding the evolution of finance helps us appreciate why finance plays such a vital role in today's economy and why it will continue to evolve in the future. Thank you for watching. If you enjoyed this video, don't forget to like, share, and subscribe for more finance and banking lessons. See you in the next video on Finance Guy.